Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 18th, 2024. Yesterday, I played some videos of people who are saying, money managers, economists, who are saying that they believe that the market is going to decline beginning in January 2025. Those included people like Felix Zulauf, Henrik Zeberg, and Daniel DiMartino Booth. All of them fairly independent thinkers, none of them tied to Wall Street, and at least 2 out of 3 they will go on both sides. When it's positive, they will go bullish; negative, they'll go bearish, etc. Maybe all 3, but I would say at least 2 out of 3. And so I think that is correct. I think we are headed, the market is too overbought, too euphoric, too overvalued to say that we're not going to be in for a correction. Is it going to be 15 to 25% as one of them was suggesting? I don't know. Maybe it's 10 to 15 or 15 to 20, I don't know. But at some point there's this euphoria where it just goes up every day, I think is short-lived. I think that will change. Not because it's the economy is going down, but because you can't just go up that far and that fast with that. It doesn't go that way. The valuations don't support it. So those are my comments. Be prepared in your investing to be prepared for, if you're a buy and hold investor, it's going to be difficult. If you're tactical, be prepared for a shift, that this is not going to continue, and use your own method to determine when that might be. Okay, I'll begin with the dashboards. This is the read from last Friday, December 13th, and you can look in the yellow box and see that most of these numbers are negative. And so these are the major indexes, 6 major indexes, 4 U.S., 2 foreign, plus the long-term government bond. The long-term government bond is at the bottom. It got killed. It was down 4.49%, and bringing down traditional portfolios. Not only were equities struggling, but the bonds pulled traditional portfolios down even further. On the year-to-date standpoint, you can see that the S&P, the NASDAQ, and even the Dow have done well on a year-to-date basis. When you look at the far right, the indicators, green light, red light, 17 out of 25 were positive, compared to a week ago, 25 were positive out of a total of 44. But across the bottom, you definitely see the long-term government bond, and you also see the developed foreign markets. When you take the S&P 500 and you break it apart into its component parts, the 11 major industry sectors, you can see that the ones that are above their moving averages, 20, 50, 100, and 200-day moving averages, is a green dot. A red dot means they are below their moving average. That tells a story. There are 26 out of 44 that are negative, compared to 31 for the previous week. And when you look at last week in the yellow box, what was positive? Consumer discretionary, the only one that was positive. Everything else was negative. And when you look across the bottom, those bottom 4, they were negative by quite a bit. And look to the right of those bottom 4, and you can see the degree in which they are below their moving averages. The bottom one is healthcare. Healthcare has been down a lot. Year to date, it is down about 20%, or I shouldn't say that. The leader in that area, or one of the leaders, is United Healthcare, and it is down 20%. So, but yeah, healthcare has been struggling, and there are winners and losers as a result of what's going on in the economy, what's going on with the election, And there are both sides to it. You look at in the pink box, the top 5, the next 2, and the bottom 4. And that kind of tells the story of, go from gains, but not great gains, to exceptionally good gains. But it's a mixture. The S&P 500 continues on its trajectory upward. There was a pullback. You can see it at the very end, the very far right of the chart. There was a little bit of a pullback last week, but very minor. Still, the S&P is well above its 20-period moving average over, this is using a 30-month chart. When I convert that over to a candlestick chart, same thing, same result. It's just interesting to see it from a candlestick perspective. So when you have a hollow candlestick, that's usually more positive. A red, filled-in candlestick is usually more negative. But it's a mixture of both, mostly positive, for the last 30 months. On a relative strength basis, the NASDAQ 100 compared to the S&P 500 looks like this. The NASDAQ 100 would be the numerator, and the S&P would be the denominator. So when it goes up, it's favoring the NASDAQ. When it goes down, it favors the S&P. So you can see at the very end that it has been moving up lately, and that means it is favoring right now the NASDAQ 100. The S&P 500, when I take that into its growth stocks versus its value stocks, growth is the numerator, value is denominator. So when it goes up, it's favoring growth. When it goes down, it's favoring value. So it has done both, a lot of both. But more recently, you can see at the very far right of the chart that it is moving up, favoring growth. But prior to this, over the past 6 months or so, it has been more down than up. S&P 500 compared to the small cap index, the Russell 2000, measured by the ETFs, SPY versus IWM. And SPY being the numerator, IWM, small cap, being the denominator. It has moved up above, the ratio has moved up above the 20-period moving average, showing that the S&P large cap stocks, not just growth, but growth and value, are above the moving average and are outpacing the small cap stocks. Although prior to that, let's go back through from say July to November, small cap stocks were actually more in favor than large cap. This is an interesting chart. This is a long-term government bond. I put 2 lines on here. One is the long-term direction of the government bond, which is the black line showing that where it's come from and where it is to today. And this last week, as I showed earlier, is definitely a negative week. I took that number at around 90, the value on TLT at the far right, and went back all the way for about 2 years, over 2 years. And in a way, it's gone above that line and it's gone below that line. But from over 2 years ago, it has not changed. Well, it's gone up and down. It has changed, but it's not away from where it started. What does that mean for traditional portfolios? Equities have clearly been up during that period of time, but bonds have not participated. So bonds are holding back the yield or the gains that are occurring in a 60-40 stock and bond portfolio. The dollar continues to rally. So you can see this is a 4-year chart. From where it was 4 years ago, you can see definitely up. So for U.S. investors, companies, individuals who are buying goods and services in foreign countries, this is favorable. The dollar goes further. If you're in a foreign country and you're investing in or spending money in the U.S., this is not favorable. So, again, strong dollar. Gold has been in, again, same kind of trajectory, upward, but this last week at the very end, you see a little bit of a tick up. But there has been a little bit of a pullback for the last month or so. But by and large, the trajectory for gold has been positive and a fairly consistent chart. Silver, less consistent, up and down, up and down. Generally, I put the black line on to show you that generally it's been up. But, you know, you have to put up with more volatility. And when it goes up, it sometimes goes up very quickly. But when it comes down, same thing. Bitcoin has been doing quite well. You see the rise up. It's way above its 20-period moving average. And, you know, the election favored Bitcoin. And so those who believe in Bitcoin and want to invest in it, they're seeing numbers go very high. And, of course, it's above 100,000 now. And, again, positive for Bitcoin. The volatility index, this is downward volatility, so it goes up and down and up and down. So if the market is going up, equity market is going up, this tends to come down and vice versa. So you see, I put in the black arrow to show the direction is down over the past few months. This goes back to, looks like about July or August. And then over that, most of that 30-month period, the red line shows that the direction is down. What that means is the general direction for equities is up. Asbury Research moved a little bit more negative this past week, and as of Friday there were 3 metrics that were negative, and there were 3 metrics that are still positive. So again, a mixed picture on the Asbury 6. Cross-asset relative performance. So you see and I look at all 3 of these. Look at the last week, the last month, the last quarter, and you can see that stocks, starting at the top, looking at all 3 of the indicators, stocks favored over bonds, large cap favored over small cap, broad market favored over the NASDAQ 100, over the Dow 30, which is the blue chip stocks, and technology favored over the S&P 500, broad market, growth favored over value, U.S. favored over developed markets, and then dropping down below that, you see government bonds favored over corporate, high yield over, you'd say basically high yield over high quality, and short term over long term. The U.S. versus the world, the U.S. is favored in a number of cases. In no case is any other country or region favored over the U.S. for these 3 time periods, the last week, the last month, the last quarter. So the U.S. is favored in this period over Brazil, Peru, Canada, Switzerland, Spain, the UK, Malaysia, Japan, Hong Kong, Singapore, the Pacific, New Zealand, and Australia. So, and definitely the U.S. And this is not the dollar, and this is not the economy. This is the stock market. So the U.S. is doing good at this point, but as I pointed out earlier, a lot of this is driven by the Magnificent Seven or companies like that. When you take I use this chart, U.S. versus South Korea. There's a lot. I just showed you a lot of countries and regions, but I use this one because it shows the degree, the magnitude of the U.S. over a foreign market. And again, you can see the direction over the past 2.5 years over South Korea. A number of countries are similar. I just use this one because it is more it's a smoother chart. You know, it shows it in a more consistent manner. Gold and silver. So gold, as you saw earlier, slight tick up this last week. So it is up to $26.54 per ounce spot price over the previous Friday. And then this past Friday on silver, compared to the previous Friday, is $30.66. A gold-silver ratio is 87-1, favoring gold as a stronger number, but that makes silver actually a better buy. A monster box is 500 rounds of silver, generic silver, and that is $15,940. That includes $1.22 per ounce over spot markup, and that makes the cost per round $31.88 based on the prices I just showed, bringing the total for that box to $15,940. Courtesy of my son Preston, who is in the precious metal business. Okay, well, thank you for watching. If you have questions or comments, leave them in the comment section below. Whether they are positive or negative, I would love to hear from you. Thank you.